Good evening, guys. This is Amit Gadlani here. I'm going to talk about financial reporting, CFA Level 1. We're going to talk about what is financial reporting and why financial reporting. What is the need for financial reporting? So, let me share my slides before we go there. So, here we go. I hope you guys can see my screen. So, we are going to start with financial reporting by Professor Gaglani. And at the end of this course, at the end of these slides, you should be able to understand basic accounting concepts and principles, even though we are not going to talk about debits and credits, but we are going to talk about what are the financial statements and how to read the financial statements and how to understand and critically analyze the financial accounting concepts. So you can see here you should feel comfortable analyzing and interpreting companies' financial statements. Now, we will see in a minute what are the financial statements, balance sheet, income statement, and cash flow. And there is notes to accounts. But as a CEO, CFO, or you're in marketing or supply chain controller, or you are a chief technology officer, you need to know the basic numbers. So we are going to start with what is the first of all, what is business, what are the types of legal entities, and then we will move to financial reporting, because before we move to financial reporting you need to know what kind of legal entity we are talking about. So, and then why financial reporting, as I mentioned, it's also mandatory if you're a public company listed on NASDAQ or New York Stock Exchange in USA. You need to file every quarter 10Q, every year annually 10K, and there are some other documents like 8K, 14A, Form 144, Form 4, and ESG disclosures. But mainly we'll talk about 10Q and 10K, which is financial reporting. And we are also going to look at some of the companies in coming lectures, like technology companies like NVIDIA, AMD, OpenAI, which is part of Chat GPT, Broadcom, Salesforce, Disney, Netflix, Nike, McDonald's, Chipotle, and Kawa, and JP Morgan, which is the biggest bank in USA. So that will give you an idea what is financial reporting. So we are not only going to talk about the concepts, but I will also show you the actual 10K or 10Q of these big companies, and you can see for yourself how the financial statements are prepared, income statement, balance sheet, and cash flow, and then how do you link these financial statements to each other and understand the implications of the financial statements. Just to keep you in the background, like some of the recent scams and failures, like SBF Sang Bankfred, who was running FTX, has gone bankrupt. Binance CEO pleaded guilty. Silicon Valley Bank, you know, collapsed last year. Theranos, another startup which went bust, the CEO went to jail. There was WeWork, which valuation was 47 billion, and from there it becomes zero. And there was also Nikola, where the CEO Trevor Milton was claiming about hydrogen truck, which was never there, and how the company was again declared bankruptcy. So we will talk about all these things in coming lectures, but this lecture will mainly focus on the first of all, what are the types of businesses here. So you can see here the types of business in this slide. There are three types of businesses: sole proprietor, partnership, and corporations. On the non-business side, there's government entities, which could be federal or state and local, or private organizations like hospitals, universities, which we call it not-for-profit organizations. So these are types of entities. Now, what is the difference between sole proprietor, partnership, and corporations? Sole proprietor is just like one man show. One guy runs everything. He runs the business, he does the marketing, he does procuring, he does the financing, investing, and operating activities. So at the end of the day, if company goes bankrupt, he also goes bankrupt. So he's personally responsible for the business. Partnership is two or more people coming together. Mostly in USA, you will see law firms and accounting firms. They have this partnership structure. And then most popular in USA is corporations, where companies issue share capital, they issue shares to the shareholders. So shareholders own the company, they appoint board of directors to run the company, and then board of directors appoint CEO to run daily show. So mainly we'll focus about on corporations because these corporations, if they're public, they have to file 10K or 10Q. So as I just mentioned, the difference between sole proprietor, partnership, and corporations. And as I mentioned, we are going to focus on public listed companies on New York Stock Exchange or NASDAQ. So you can see here how the US stock market is structured. So you have stock exchanges, NASDAQ or New York Stock Exchange. So you have two options. Some of the companies are listed on both. And then there's over the counter market where the companies who are not yet public, but they still want uh, to sell the shares. So they prefer OTC market where you deal directly with another company. So we are mainly discussing about the companies which are listed on New York Stock Exchange and Nasdaq. So as we said, why corporations? We just saw partnerships, sole proprietor, and corporations. So why prefer corporations over sole proprietor and partnerships? Because corporations is a separate legal entity from its owner. Owner of the corporation is not personally liable for the debts of the business. So if company declares bankruptcy, that doesn't mean you also declare bankruptcy because you are just the owner of the company, you are a shareholder. You lose, of course, your capital in the company, but only to the extent you invested in that company. Let's say you invested $10,000 in a company, you lose that $10,000. That's it. Nothing else happens to you if, in case company goes bankrupt. And then ownership of the company corporation is divided into transferable shares of capital stock. The owners are called stockholders or shareholders. Corporations are dominant form of business in terms of dollar value of the business. And as I said, even though you, as a shareholder, you own the company, but you don't run the company. The company is run by board of directors. But again, board of directors also don't participate on a daily basis. They appoint CEO, CFO who will run the company on a daily basis. So that's, and now we're going to look at the model of business activities. So how does the business activities start? It starts with financing activities first. Let's say you are starting a business. So to run the business, what do you need? First of all, you need finance. So there are two options in terms of finance. Either you raise money through IPO or you take a loan, either private loan from venture capital or you take a loan from the bank. So that's the starting point of every business activity, the financing activity. Once you get the finance, you will invest that money into your business by buying the assets like furniture, plant and machinery, uh, and some other assets. And then once you buy the assets will generate the revenue. That will generate the operating activities. So you will have revenue and you will have expenses. So let's say you're running Chipotle, which is a Mexican fast food. So once you start, you bought the asset. Let's say you bought the office, you bought the shop, you rented the office, you will start your business. So now you're selling this Mexican food, which is your revenue. And what are your expenses? Your payroll, you're hiring people, you're buying the food from suppliers, all that is your expense. So that revenue minus expense is your operating activity, and you will generate some profit. Now that profit again you will invest back into your business, so that will become financing activities. So this cycle goes on: financing, investing, operating, again financing. So I hope everyone is clear about it. Any questions so far? Good. So let's move forward. So as I said, what are the examples of operating activities? So you can see here the operating activities are sale of products, like in case of Chipotle, you're selling the Mexican food. If you are running Microsoft, you are selling the software. If you're running Priceline.com, you are buying and selling air tickets, hotels, rent a car. Let's say you are in a business of selling cars, so you will sell the car, right? For Toyota, Ford, GM, Audi, all those cars. So that's your business, selling cars. And now, as I said, what are the other operating activities? So sell a products, and then what is the cost to incur operating business, right? What are your daily activity, right? You will hire the people, they will run the show for you. So you will pay them on a bi-weekly or monthly basis. So salaries and wages, that's your expense. You will buy stuff from vendor, like let's say you're selling Mexican food. So you will buy cheese, you will buy guacamole, you will buy chicken, all that stuff from the vendor, and then that you will sell it to the customer. So let's say you're buying from the vendor, which will cost you $50, you're selling it for $75. So that difference between 75 and 50 is your profit of $25. So, and then as I said, paid salaries to employees, paid taxes to government. So these are all operating activities. What is the investing activity? Purchasing and selling of assets like furniture, office, car, plant and machinery, all that is your investing. And where this investment will come from? Financing. So as I mentioned before, you have two options. Either you borrow the money from the bank or private investors, or you sell the stock and get listed. So you're selling your stock to the shareholders and you get money from the shareholders. But then you're responsible to the shareholders. So now, after understanding this whole background of business, how business is run, let's talk about financial reporting. So, what is financial reporting, right? It's often called general purpose accounting information. A lot of people think financial reporting is accounting, but no, it goes beyond accounting. Accounting is just a process. You're preparing certain journal entries, you're booking the numbers. That's accounting. But financial reporting is the financial statements. So you can see here there's a difference between financial reporting and management reporting, because financial reporting is external, it's public, it's the information is available publicly, versus management reporting information is confidential. It stays within the company. It is more detailed. Like for example, if I'm Disney, my management reporting will contain all of my products like parks, movies, uh, some of the other activities I have. And then within parks also I will have parks in Florida, parks in California, parks in China, parks in France. All those parks, I will have the information like how much revenue I generated, how much cost I have on those, whether I'm making profit or not, and that will help me in decision making. So understand this financial reporting, why we are doing it. We are doing it to enable us to make a decision. What is my decision making? The decision making you will see here if I look at this slide. This slide is very important. Like, who are the users of financial reporting? So you can see here, internally it's management, externally it's stockholder, banker, employee, and supplier. And why he needs financial reporting? For example, management needs to know if we are running this McDonald's or Chipotle, if I want to add another chain, let's say I already have 50 locations, I want to add one more location, then financial reporting will help me whether I should add one more location or not, because I will see if that location I'm able to generate profit or not. If I can make more profit, obviously I will open another location. As a shareholder, why I need financial reporting? To make a decision whether I should buy shares of Chipotle. Let's say I have $10,000 and I have two options, Microsoft and Apple. So how do I make a decision? I will go through financial statements of both Apple and Microsoft. And then whoever is making more profit, whoever is giving me more dividend, I will go for that company. So again, financial reporting will help me in making a decision. Then as a banker, Also, it will help me the financial reports because as a banker, I have given you a loan. So I'm interested in knowing how you're using my loan, right? Are you making profits or you are wasting my money, right? So as a banker, I will ask for financial reports, financial statements, preferably audited by a reputed company so that I can trust the numbers. But once you give me the financial statements, I can see, okay, I gave you a loan of let's say 1 million. Out of that 1 million, you're generating revenue, you're making profits, you're paying it, your employees, and still your bottom line is profitable. So you will be able to pay me interest on my loan. So I want to ensure my loan is safe, right? So that's as a banker, I need financial reports. As an employee, also, financial reporting is helpful because if I'm working for your company, I need to know whether I should continue. What are my prospects here, right, in my job? Will I make more money next year? If company makes more money, I make more money, right? So I need to know the financial reports, right? Because that will decide my bonuses, my raise, my long-term future in the company. As a supplier also, as we saw, if I'm a supplier to the Chipotle, I'm supplying chicken, I'm supplying cheese, I'm supplying guacamole, all those ingredients. So when I'm as a supplier, I'm giving you stuff, obviously I'm giving you a credit of 30 to 45 days. So you have to pay me within 30 to 45 days. So I'm very much interested whether you are making profit or not. If you are doing well, I feel safe, right? That yes, I should continue to supply you the material. So that is financial reporting. And then some of the other stuff here, uh, as we saw, internal users, external users. The other very important thing here is like you must have seen, like some of the companies have gone out, like Blockbuster, BlackBerry. These companies disappeared because they were not making profit. The other stuff is, as a CEO of the company, public listed company, every quarter I need to attend the earnings call where the analysts from Wall Street, like big banks like Goldman Sachs, JP Morgan, Wells Fargo, they will ask me the questions about my past performance and my future prospects. Like I need to issue a guidance like what do I see for next quarter, whether my sales will go up, whether my earnings will go up. I need to talk about top line, which is revenue, bottom line, which is net income, and then earnings per share. Those three things I need to talk about it. If these things are going up, I'm safe as a CEO, CFO. Otherwise, I could be in trouble. So keep that in mind, please. Some of the other stuff we need to talk about, financial reporting. Make sure. The other thing is, as a public listed company, I need to get my financial statements audited. Some of the scandals in the last 25 years, again, as you must have heard about this Enron, which happened in 2003, and because as a result, SOX 404s, Sarbanes-Oxley Act 404 came into effect, which was like you need to CEO and CFO need to certify about the internal controls operating effectively in the company. So not only the numbers, but also internal controls. And then we also saw 2008 financial crisis, where AIG, uh, insurance company, went into trouble because they were issuing credit default swaps to all the big banks, and big banks were issuing housing loans, mortgages to subprime creditors, and against that they were taking insurance from AIG, and then AIG ran out of liquidity, and then this crisis happened. And obviously, U.S. government stepped in, uh, and then all the banks took help from the U.S. government. But that was a big crisis. And then there have been some other accounting scandals. So we will talk about these scandals in coming lectures. But right now, I just want to give you an intro, touch into financial reporting. Also, we need to talk about, as I said, uh, you know, accounting systems. Now, financial reporting is the end product, but how that product is developed, it's developed through accounting systems like Oracle, SAP. They have these ERP systems, which includes accounting softwares where you can record daily accounting transactions, daily operating, investing, and financing activities, which will result in the financial numbers like income statement, balance sheet, and cash flow. And then also there are some other sources of financial information besides balance sheet, income statement, cash flow. There is footnotes to the financial statements which will talk about accounting policies, because companies have option, either they use US GAAP, US generally accepted accounting principles, or IFRS, international financial regulations. Mostly US companies stick to US GAAP, European companies use IFRS. Sometimes companies use both depending on where they're listed. So we will talk about that in coming lectures. And some of the principles of this, like how financial statements are prepared, they're prepared on the assumption of going concern. That means company is going to continue to operate for multiple years. It's not just 1 year. And then there is a cost principle, monetary unit. Every activity has to be expressed in terms of dollars, rupees, or euro. That is very important. Yeah, as I mentioned, US GAAP is the major major accounting principles everyone uses. And who prepares US GAAP? It's prepared by FASB, Financial Accounting Standard Board. They prepare all these accounting standards, which is called FASB, US Financial Accounting Standard Board. IFRS is prepared by ISB, International Financial Reporting Standards. Now, as I mentioned, uh, as you can see, it's AICPA, which is American Institute of Certified Public Accountants. As I mentioned about SOX 404, which is monitored by PCAOB, Public Company Accounting Oversight Board. These are some of the major things to keep in mind. As I mentioned, most of the Fortune 500 companies are audited by Big Four. You must have heard these names: PwC, KPMG, Deloitte, EY. So they have to issue audit report. And as you can see here, management has to express an opinion about effectiveness of the intercontrols, and then auditors will express an opinion. There are three types of audit reports issued: clean report, where auditors says everything is good, they're happy, they have reviewed the financial statements, they have audited financial statements, they have taken sample of transactions to ensure everything is good. But there could be a qualified report where they will say everything is good except this one particular area, maybe a lawsuit liability, or maybe a inventory valuation. So that's qualified report where they say, okay, 90% is good, but this 10% we are not comfortable, so we can't express opinion on that. So that's called qualified report. And then disclaimer, very, very extreme case where company is unable to express opinion, they will just walk out from the audit. They will say, we cannot audit this company, and we are not very comfortable, and you must have. And this happens very, very rare cases where it's very clear that auditors know that something fishy is going on, and we cannot issue a clean or qualified report. So they will just walk away from the audit, and then the company has to look for another auditors. I think most recently this happened with super microcomputers. And then let's check the concepts here. So here's the question. Let's make sure you are paying attention. Auditors are independent parties that help A, B, C, and D. A, establish accounting rules. Do they make rules, auditors? We saw that it's not auditors, it's FASB, Financial Accounting Standard Boards. They establish accounting rules. Do auditors ensure management has appropriately prepared company's financial statements? Yes, I think so. And then investors and creditors in their decisions, auditors help them, right? Because their auditors are supposed to be independent. So they come in, even though they're paid by the company, but they're still independent. And they help investors and creditors in their decision making, because when investors and creditors see that, okay, these financials are audited by somebody, maybe Big Four or somebody, that means they can rely on the numbers. The numbers are fully supported, they were properly checked. So my answer would be B and C, both. Now, there's another thing in this public listed companies, they need to have this audit committee. The audit committee normally consists of 6 people. As you can see, maximum 6 people. For all the public listed companies, qualifying audit committee is required in USA, and then it has to have at least one independent outside director. So make sure, not like you can see here, the audit committee will consist of at least three and no more than six members. Each committee will be both independent and financially literate. Because this committee's job, what is their job? Audit committee's responsibilities, they have to oversee financial reporting and disclosure process. They have to monitor choice of accounting policies, how they are accounting for certain things, like revenue recognition, inventory valuation, lease accounting. These are very, very critical accounting accounting examples where you need to ensure that company is doing proper accounting. Like for example, software company getting a project getting a project of 10 million, they can't simply go and book 10 million revenue in the first year. They can only book revenue based on how much work they complete each year. Let's say this project they're going to complete in 3 years, so then it will depend how much they complete each year. So that's revenue recognition. So audit committee will ensure that company is doing proper revenue recognition. So some of the, you know, and also they discuss risk management policies. They make sure the inter-controls are operating effectively. They are put in place. There's internal audit function is in place. All big companies, at least all the publicly listed companies, they need to have internal audit before external audit come in. Statutory auditors, they are also called external auditors. Before they start their audit, internal audit has to complete their audit and they have to submit their report. So external auditors will rely on internal audit report. So, and then we will also talk about ethics, which is also very important. So this is financial reporting in nutshell. And I will start my screen here and I will go back to my video here. So I hope you enjoyed my video today. And if you have any comments, please let me know. But thank you for attending this lecture. And right now, I'm going to close this. So I'm going to share this link here.